Welcome everybody to the webinar. I'm Kathy Stanton and I will get the presentation started here. We could go to the next slide. We're going to talk about the Wayfair decision and 3 years later, what's old, what's new, what's next for state and local taxes. Okay, the agenda. We're going to talk about the evolving implications of Wayfair. We're 3 years later, a lot has happened, not only in sales tax, but in income tax. We're also going to talk about the industry impact. We're going to give some insights on what we've seen in certain specific industries and how they have been impacted by Wayfair. And then we're also going to look at trends to watch in 2001 or 2021, sorry, and beyond. What are some of the trends that we're seeing and what are we expecting? So Lauren, I think you can take it from here, the next few slides.
Sure. Thanks, Kathy. So, obviously a lot has happened in the world of sales tax in the last 3 years. And what we want to focus on today is where we are and what we've seen in the last 3 years. So if we can advance the slide, yeah. So the first thing that we want to make sure everybody realizes that even with all the changes with economic nexus, the old physical presence test still rules. So even if your company does not meet economic nexus, if you have a physical presence in that state, you will still have nexus. So physical presence can be created through various means and various different connections with the state. It can be from offices, employees in the state, representatives, even independent representatives visiting prospects on your company's behalf, keeping inventory in a state. If you are a Amazon FBA seller and you've got inventory located at any of their warehouses across the country, that will be a physical presence in that state, as well as customer visits. So if you're going on site just for a customer goodwill visit or a customer, you're doing some services on site, all of those different activities will create a physical presence and can create sales tax nexus and sales tax obligations on your behalf. So
And while we're talking about physical presence, I just wanted to take a couple minutes to talk about coronavirus impact on Nexus, because this is really important. And I can't imagine any company that has not been impacted by this and the telework situation. So sales tax and income tax Nexus can be impacted by the mobilization of the workforce. About 20 states have provided guidance in the income tax area for corporations mainly. You don't even get the guidance necessarily for pass-through entities. That Nexus won't be triggered just by the presence of teleworking employees. And for sales tax, only about 14 states have provided guidance. And out of both income tax and sales tax, one of those states that provided guidance was Maryland, and they basically said, we're not giving any relief. So it was nice of them to let you know that they're not giving any relief. You have to be really careful. You want to look at the specific state rules and whether they do have some alleviation during the pandemic period. And the issue is that this guidance isn't statutory necessarily, it's just the Department of Revenue guidance, and it's not always entirely clear. Sometimes the state has to be under a state of emergency for that guidance to apply. So you have to look at, okay, well, when did this state of emergency lift? Some states, it's just general, telecommuting temporarily due to the pandemic. Well, what's temporarily? We can argue that's still happening today. So you really have to be careful and look at that if you do have employees in other states where you have not been filing. And then recently I had read, I think in Forbes, that 7 out of 10 jobs are expected to be more hybrid work from home and work in the office going forward. So we're going to have a lot of employees working from their homes potentially going forward. And what does that mean on Nexus? And physical presence, states generally want to right away say, you have physical presence, you have Nexus. You don't even have to go to the economic Nexus rules. So you really want to look at that, and not only from a sales tax and income tax perspective, but from payroll. So, and payroll has different Nexus rules or different reporting rules based on income tax withholding versus unemployment tax. And there is, interesting enough, there is a request at the U.S. Supreme Court right now from the state of New Hampshire suing Massachusetts, saying that Massachusetts is trying to tax the telework commuters or telework employees that are sitting in New Hampshire, not entering Massachusetts at all, and Massachusetts is withholding income tax on them. And New Hampshire says that's not fair, it's outside of your borders, you can't do this. So we'll see if the U.S. Supreme Court takes that case. Will be interesting, and it has further reaching implications on some of the aggressive states for payroll withholding, such as New York, that withholds New York tax no matter where telecommuters are located, and they've done that for years. So a lot going on there just related to employees located in other states. You really have to look at this, or look at all of those facts in the Nexus landscape. Next
I
slide.
think that's great information, Kathy. Um, so now, moving on from the physical presence test, we wanted to touch on the economic nexus requirements and the pace of adoption. So Wayfair was decided in June of 18, and we put these slides together just so you could see how quickly the states have adopted. And Kathy and I have been working in state and local tax for a long time, and I don't know that we've ever seen any state, let alone collectively all the states, move so quickly to jump on any bandwagon. So this map shows 6 months after Wayfair passed, the green states adopted economic nexus quickly. The next slide shows you 6 months later, then another 6 months later. You can see where the map is almost all green. Then we've got almost a year later, where it's Florida and Missouri are the holdouts. Flip to the next slide. Here's today. We've got Florida, who is upcoming in, 6 days. Economic Nexus goes live. And one last slide. Missouri has passed, but Economic Nexus does not kick in until 2023. So you can see that just the speed that the states have adopted this, the states are, they're looking at this as a great opportunity to collect all that uncollected tax that was escaping through, online sales. So, what does this mean, and are we close? Are we close yet? The economists say that only a fraction of the 2.1 million of online sellers are actually in compliance. So even with all those green states, there's still almost a $1 billion compliance gap. So looking at the summary of state thresholds, you can see that not every state defines economic nexus the same, but you'll see some trends. And we've picked out the four kind of common thresholds. So you can see that most states have adopted the same threshold that Wayfair was, with $100,000 of sales into a state or 200 transactions. There's a number of states that have used that same $100,000 of sales but don't have any transactions. Some states have lower, or have a higher bar with $250,000 of sales, and 3 states, which are the biggest states, California, Texas, and New York, have a 500,000. Now it's important to note New York is 500,000 and 100 transactions. So you can see that there's a lot of different states that look at what those thresholds are differently. We have seen a lot of movement with states going, some have gone down and some have gone up. And I think what we'll see moving forward is some continuous motion. Lauren's crystal ball, I think that they're going to eliminate a lot of the 200 transactions where it's really based on sales thresholds, but we will see. And I think that brings us to our first polling question. So polling question number 1. What activities may create sales tax nexus? A, employees working in a state. B, employees inventory stored at a third-party fulfillment center. C, independent sales reps visiting customers on your behalf. D, passing economic thresholds. And E, all of the above. So we'll give you a little bit of time to answer these questions. And I think it's important to note that this is a sales tax question, and what creates Nexus for sales tax is much different than what creates Nexus for income tax. Hopefully you've gotten your answers in. And do we have the results? All right. It looks like most everybody got the answer correct because it is all of the above. So if your company has any of these activities, those can create sales tax nexus for your company. So it's, again, very important to be looking at all the different activities that your company is doing. So moving on to the next slide. I thought our friends at TaxStar put this together, and I thought this was a great information. And they looked at the country's demographics and how the population is spread out to really help people analyze and understand what is economic nexus, what does that really mean? So looking at it from a transaction lens, if your company is selling 1,000 orders a month, that will likely give or create nexus in 12 states. 10,000 orders a month, you're looking at 27 states. And then from a sales perspective, if your company has $5 million in annual revenue, and that's not a large company, but that will create nexus in about 15 states. And at 50 million, you're looking at almost widespread nexus with 44 states. So this is some great takeaways to just really benchmark where your sales are and where your current filing situation is.
Okay, I'll talk about some income tax nexus for a few minutes here. As Lauren mentioned, we have different nexus standards depending on the type of tax that we're talking about. Physical presence nexus, that's when, I started my career years and years ago. It was always, you had to have some kind of physical presence before that state can assert its taxing jurisdiction over you. And I'm amazed at how many clients still think that or maybe feel that. But income tax, or for income tax purposes, economic nexus, which simply means not a physical presence, just enough economic activity coming from the state, economic nexus has been alive and well for quite a long time. Since the West Virginia MBNA case in 2008, West Virginia Supreme Court said that Quill was a sales tax case, not an income tax case. We're not bound by physical presence for income tax. And the US Supreme Court denied cert in that case. And from that point forward, a lot of the financial institutions adopted economic nexus standards, and then that kept growing, and states just actually started applying economic nexus long before Wayfair. It started off with mostly in the licensing of intangibles. If you've been in the profession for a while, you'll be familiar with the term Jeffrey and the Jeffrey case. Just the presence of Jeffrey on the Toys R Us stores created nexus. Also financial institutions, as I mentioned. About 15 states have adopted some form of a factor presence nexus standard, which means if your sales exceed this level, you have nexus. That's significantly behind. If you remember the map that Lauren just clicked through, all the states that have sales tax have now provided guidance that if you have this many transactions or this much in sales, you have a filing obligation. And that's actually a matter of good tax policy. You don't want to have taxpayers guessing whether they have an obligation or not. I mean, they want to comply with what they're required to comply with, but they need clear guidance in order to know that. And on the income tax side, we've only had 15 states that provided a factor presence nexus, and we've seen states be very aggressive in economic nexus. Wisconsin kind of stands out, but they're not the only one where, $20,000 is enough to have to file an income tax return. And the states have been successful in asserting that argument to date. So the states now under Wayfair, and with the US Supreme Court saying that $100,000 is enough, the states are much more emboldened to be more aggressive. So the Californias that start at 500,000 and above, they still have their standard, it's indexed for inflation. But some other states now, such as Hawaii, has adopted $100,000 amount for Economic Nexus in Hawaii, and they actually adopted a transaction number too for income tax, not sales tax. So that's very odd in how that gets applied. But there are a number of other states and local jurisdictions as well that are, and I hope all the states actually provide some kind of threshold so small business gets some certainty. But also in the economic nexus area, unless you're just selling tangible personal property where you know where you're selling it, or you have real estate where you know where the real estate's located, if you're in the technology industry or service industry, now we have an issue of how do you determine your revenue by state? Is it where your employees are working? Is it where your customer is located? In some states, you have an odd cost of performance rule where it's all or nothing based on where the majority of the cost of performance are being incurred. So now we have this sourcing question of how do we determine where the revenue is sourced? And unfortunately now that sourcing question has to be answered before you can determine whether you have nexus. Because depending on how you source it, I could have zero revenue in the state or 100% of my revenue in the state, depending on how the state sourcing rule works. So you have to answer the sourcing question to determine whether you have nexus in the income tax area. If it's not like boots on the ground or tangible property where you know where that activity is located. Next slide. The MTC, the Multi-State Tax Commission, had adopted a bright line factor presence standard back in 2002, and we're encouraging all the states to adopt this to provide more certainty to their credit, to give assurance to the taxpayers on what creates nexus. So this was back in 2002. So this is well before the MBNA case and long before Wayfair. So MTC has been pushing for that. And it seems the only really relevant one that it seems to me is more on the sales side, if sales exceed a certain threshold. Because once you have payroll, once you have property, I just don't, unless we have a federal law protection, which we'll talk about in a minute, the state generally says you're doing business in the state if you have payroll property. So I've not seen those thresholds protect many taxpayers in practice. Next slide. I wanted to mention the Pike balancing test. This came up in the oral arguments of Wayfair, and I had never heard of it before. Many state tax practitioners had never heard of it before, and it's not even a tax case. But basically what the Pike balancing test says is that if there is such an extreme burden imposed on interstate commerce and on taxpayers conducting business in interstate commerce that clearly exceeds the benefits they're getting from the state, that it's going to be unconstitutional, or it's not going to hold muster under this Pike balancing test. It was under the Pike case. And this case actually involved melons and labeling of melons. And I'm forgetting exactly which state it was, but was it maybe Arizona, where they were growing these melons and they had a labeling facility in the state just across the border and packaging facility. So they picked all these, took them just right down the road, which was in another state. They labeled them and shipped them out. Well, Arizona, I think it was, and I apologize to Arizona if it's not, but they had a regulation that said you have to package and label them in this state if they're grown in this state. And I guess they were really proud of their melons. Well, in order for the taxpayer to comply with that, they would have had to spend millions of dollars building a facility so that they could label these melons. And so the US Supreme Court said that's absolutely absurd. The costs are way in excess of what the benefit is. You can't force them to build a new facility to get your, and that wasn't even a tax, that was just to get your labeling occurring in the state. So how does that apply here? I would say in the income tax area, Pike balancing can apply if you have if somebody has to file in all states that impose an income tax. Say you're only, a small $500,000 seller, $1 million seller, but it's all spread and all the states come after you for income tax. You have to file 50 tax returns when you don't even have income. I'm just wondering if that Pike balancing can come into play. They did talk about it for Wayfair, but because there was technology and the technology providers were saying, yes, we have technology to prepare all these returns, it didn't help them in Wayfair because technology solutions apparently were available, which we all know isn't always the case. Technology, it's getting better all the time for sure, but it's still an expensive proposition.
Kathy, I would think a lot of small sellers would really argue that even with technology, the best technology, it is still a sales tax compliance is still a huge burden.
It's a huge burden. And, it was really interesting listening in the oral arguments that I think it was Justice Breyer that said, okay, I have an amicus brief here that says the cost of compliance is $19. And I have another amicus brief from another party that says cost of compliance is $250,000. And he's like, what is it? Is it $19? Is it 250,000? I mean, they were frustrated and just trying to get their arms around what is the total cost of compliance. Unfortunately, you have technology companies that want to sell their software. Oh, yeah, it's easy. And under streamlined sales tax, you can file your tax returns for free. And, we all know it's not necessarily the tax return, it's getting the right tax on the invoice sometimes that, is more expensive. But unfortunately, like I said, U.S. Supreme Court just kind of bowed out of the whole issue. And unless we have Congress step in, we have what we have. So also for income tax, I wanted to touch on Federal Public Law 86272. Many people are not familiar with this, although it was a federal law that was put in place in the 50s. And this says that states, and it only applies to income tax, states may not impose a net income tax if the only business activity in the state is solicitation for the sales of tangible personal property. You also have to ship it from outside the state into the state. And there's not a whole lot of guidance. You have the federal law and you have a US Supreme Court decision, the Wrigley decision out of Wisconsin, that gives you some definition of what solicitation means. But if you are a seller of just tangible personal property, you potentially have this protection. So sellers on Amazon, if you're just selling from a website, shipping intangible property, you may not owe income tax. So this is something you don't want to forget. However, there's been some activity in this area that I wanted to make everybody aware of. Next slide. The MTC, Multi-State Tax Commission, which is kind of a quasi-governmental organization, a lot of the states, not quite half the states are members of the MTC. They'd love to have everybody be a member, but the big ones like New York, Texas, and California are not members. They like to make their own rules. But the MTC provides some really good uniformity for states to adopt and try to help taxpayers not have to comply with all these different rules, but bring some uniformity so that compliance is eased. This federal law, public law, is over 60 years old. So the MTC is revising its guidance. They provide a statement of information providing guidance on how Public Law 86272 is going to be interpreted by the member states. And a lot of other states will use it too, even if they're not members, because all these states got together and said, hey, we think this is a good idea. They've updated it in the past before, but this update I think is extremely significant, much more significant than any of the other updates. And they're looking at, okay, we're conducting activity, business activity completely differently now. It's all over the internet. So they're actually looking to identify business activities that are occurring in the state, regardless of whether it's in person or over the internet. So what is that activity in the state? That's kind of what it comes down to. And if that business activity that's occurring in the state exceeds solicitation, immunity is lost. So I want to caution people, because this is something we brought up in the working, or practitioners, not me personally, have brought up on their working committee calls, that a lot of these activities we used to do over by telephone in the past. Before computers were ever invented, it was always protected. There was never any issue. Well, the states now are saying, and the MTC saying, well, maybe that wasn't the right answer. So even things that you're doing over the telephone, although they're not giving clear guidance with regard to that, they have decided to not comment on whether conducting activities over the telephone creates nexus. So next slide. So here are activities that they consider that defeat the federal law protection. Any post-sale assistance provided by electronic chat or website email, okay? That's, a chat on how to buy something through the cart would be okay, because you're just still buying the property. But any any question on the product, anything post-sale, now you don't have public law immunity, which over the telephone in the past is people can call you up. We never considered that as losing immunity. Solicitation of online applications for branded credit cards. You get interest income from that. It's not sales of tangible personal property. Receiving online employment applications for non-sales positions. So if you have a website, you're receiving applications for new to fill roles, and it's not a sales position role, that state says you have no public law immunity under this guidance. Now, this hasn't been formally accepted yet. That's expected to happen in August. Where it's at right now, it's sent out to survey all the states to get the feedback, but I highly doubt it would not pass. So I think it's gonna be adopted in August. Dropping cookies for purposes other than solicitation of sales or activities ancillary to solicitation. So if you're gathering that information from customers for production scheduling, to develop new products, anything like that, use of data analytics, you don't have any protection. Also remote repair and upgrades, transmitting code, offering and selling warranties, presence of inventory, no protection, streamlining of videos and music. So you can see that the states are really looking at trying to really gut public law, because they know that in today's economy, you really want customer satisfaction and differentiate yourself from your competition. And that involves really customer service and connection and also data analytics. You want to improve your process, improve your business, all those things. They're going to be able to gut federal law protection basically under this thinking. And I will note that under that last bullet, the commission did acknowledge that this could extremely affect small business, right? The negative impact of small business. And they're encouraging states to look at that factor presence nexus standard if they have not adopted it, that they should be looking at that, because again, you get to really harm all these small sellers. So next polling question. Physical presence still plays a major role in determining income tax nexus, true or false? So physical presence still plays a major role in determining income tax nexus. I'm emphasizing income tax as opposed to sales tax. So we'll give you some time to answer this question. We don't want anybody to miss the CPE if they had to run out of the room for a minute. So we're allowing a few additional moments for you to come in and answer this question. And yeah, so I would just say, if you have a lot of sales, what's a lot? That's subjective, but if you're selling to customers in other states you're not filing, really every year you need to look at Nexus. And you need to look at, if you haven't done a deep dive on your sourcing, if you don't have a simple sourcing issue, such as like tangible property or real estate, you really need to look at the sourcing rules, and they change as well. So maybe we can see true. This maybe was a trick question, because I'm going to say, the right answer here really is false. Because physical presence in income tax, remember I mentioned that economic nexus was alive and well long before Wayfair. So it doesn't really play a major role anymore. It's economic nexus. Do you have enough revenue coming from the state where the state says you have nexus here? And remember, only 15 states provided a threshold. So the majority of states don't even give you a threshold, but they say if you're earning income from sources within the state, you have to file a tax return. So that's why Public Law 86272 comes into play on that protection, if you could qualify for that protection. Okay, moving on. What if you owe back taxes? I would say that probably many attendees of this on this call, their companies probably owe taxes in states they're not filing, is what we're generally seeing. So what do? Well, first you want to find out what is the exposure, applying the right sourcing rules and everything else. There are voluntary disclosure agreements that you can apply for. You usually want to go through a professional like a Cherry Bekaert to do that, because you do it on an anonymous basis. You could go through a managed audit process where you kind of audit yourself, or you could just file returns in the sales tax area. You could register with the date you started and pay, the back tax returns and pay the penalties and interest. What you want to look at here is, what is the liability? If the penalties on the liability are more than, say, 10,000 or even 8,000, then you want to consider probably a VDA or some kind of remediation. If the penalties are, less than that, the penalties are smaller, you could just file and then, pay the penalty. I will say, remember, if you don't file a tax return, there's no statute of limitations. If you don't do a managed audit or register to the beginning date of Nexus or do a voluntary disclosure, the benefit is it cuts off all old periods. You can generally limit the amount you pay to 3 years. Some states can go, exception would be 6, but the average is 3. And you don't have to pay any of those prior years. That's the benefit of voluntary disclosure agreements. Because if you get audited, they're going to want returns for all of those years. Some states practically may stop at 6 or 10 years, but some states, I've had states go back years and years and years. And then just even if the tax is small, the cost of preparing the tax returns for all those years is significant. So you really don't want to bury your head, especially if you want to sell your company at some point and due diligence team's going to come in. It's just better to just get it cleaned up. And I always say, that if you want to pay the least amount of money, get it all cleaned up and comply. Yeah, it may cost you a little bit more right now, but I guarantee you, if you wait, the longer you wait, it's going to cost more to clean up. Okay,
And I
next
think,
slide. Yep.
look, thinking about exposure from a sales tax economic nexus point of view, we're now 3 years past, and 3 years is a long time where a lot of liability can creep up. So if certainly look at your exposure and look at voluntary disclosure agreements as a way to remediate. So now we wanted to touch on a few different industries and really the impact of kind of this life cycle of Wayfair adoption. And we look at it maybe in 3 different categories. Kind of that first initial stage of why do I have to file in these states? Just really understanding Wayfair and the impact it has. And then kind of the heavier lift, I think, is more the how. Okay, we understand we have to collect sales tax. How are we remote sellers are actually in compliance? It certainly varies from industry to industry, but we're starting to see a lot more traditional e-commerce sellers, understand their obligations, keeping track of them, and now moving into how are we going to do this efficiently? And where we're seeing the biggest challenges, and if you can go back one slide for a second, if you can, where we're really seeing the biggest challenges is really around the platform integration and making sure that all your systems are talking to each other. So your shopping cart and your platforms and your marketplaces are all talking to your tax engines. Everything is set up correctly, so all your systems know what to collect tax, what rate to collect tax, and how to file your tax returns, and everything's working seamlessly. But as I mentioned, now moving into the efficiency, the sellers are really starting to see that ongoing burden of the compliance with new Nexus and new products and new platforms and new marketplaces. So it's not we got set up correctly and we're done. It's this constant evolution. And starting to see a lot of notices come from states, and that's putting a burden on the sellers because just a time suck for their sales tax compliance. And then really looking for more ways to be the most efficient in this area.
Okay, for Amazon FBA sellers and others that might have the same fact pattern, I just want to make you aware that, in the past, having physical presence, that inventory in the state, inventory in Amazon warehouses where you still hold title, that creates nexus. It creates nexus for income tax, creates nexus for sales tax. Now, for sales tax purposes, we now have marketplace rules where Amazon has to collect and remit the tax. But if you have your own website sales, obviously you're subject to rules. But that has alleviated some of the burden. If you're only selling through Amazon for sales tax, you get some alleviation of that burden. But for income tax, you have inventory in the state. California is being extremely aggressive in this area, which really is unfortunate because California even has adopted the MTC threshold where they say if you don't have more than $50,000 of property in the state, you're below the threshold and you don't have to file. But California is saying that that threshold doesn't apply. For some reason, they're saying it just doesn't apply. They have a statute that's broader, or actually in the same section of the statute, there's a broader application that if you engage in a transaction, you have nexus. So they're saying that even if you only had $200 inventory stored in the state, you have to file a California return. And for the small sellers, you would think, why do we chase them down? But they get $800 minimum franchise fee from all of them. So you have Online Merchants Guild has brought suit in California, Pennsylvania. There's probably some other suits as well, saying that the small amount of inventory that the seller doesn't even control, it's Amazon that controls it, shouldn't create nexus. But as to date, I've never seen a state give on that issue. So it'll be interesting to see if anything happens there.
So moving into technology industry, uh, I feel that the sellers and most companies are still in that why stage. There's a lot of companies that just don't understand that Wayfair affects them. And I think the reason is because Wayfair seemed to be a traditional e-commerce e-commerce related issue. But when you really look at what the impact is, it affects any company selling over across state lines. And that includes most software, SaaS, and digital product sellers. So we're finding that they're still in that why stage and not being compliant with Wayfair and really needing remediation. So for them, first we have to get this industry to understand the why, and then the how becomes even a harder question. So with technology, some of the challenges revolve around characterization of the product and services, especially with complex products. So we spend a lot of time really looking to answer the question, what is it that you're selling? Are you selling a sale of a technology solution, or are you selling a technology enabled service? And sometimes that characterization is really the challenge and a stumbling block to understand if your product is even taxable in a state in which you have nexus. The second issue is sourcing. So sourcing, like Kathy mentioned, for income tax, it's a huge issue for sales tax as well. Is where's the customer getting the product or the service, or where's the benefit received? Um, we had a situation where we had a client that sold electronically downloaded software, but the customers was in one state, but it was downloaded on an Amazon server in a different state, and really having to understand the whole fact pattern to understand what state was the jurisdictional control for that transaction. And even the Massachusetts Supreme Court recently ruled that the transfer or possession is really it's very challenging, especially when products and services are used by multiple users in multiple states. So sourcing is just a really complex area that when you start getting into the nitty gritty, and of course the devil is always in the details, it becomes a big challenge for the technology industry. And then the third area is when you have bundled services, where you're mixing both taxable items and non-taxable elements together for one price. So you can see that how we're going to collect tax, and really it boils down to what we're going to collect tax on, is it's a challenge.
And where you're going to report it, right?
Exactly.
Uh,
Exactly.
Yeah, and this is, I think, the saddest slide actually in the whole deck. And the ones, honestly, I just want to, I'm not a state, I'm a practitioner, but I just want to apologize. I just want to apologize to everybody in the technology industry because you are a casualty. You are a casualty both on the sales tax side, you are a casualty on the income tax side. This is arguably the most negatively impacted industry in the area of economic nexus, especially those emerging technologies where you're just getting started, you don't even have profit yet, you're growing, but you have users everywhere. And I mean, this is where I get to the kind of the Pike balancing. Is this, really, really burdensome, and it just doesn't make sense, and it shouldn't be allowed. But here, technology, that sourcing of revenue, you have different rules on sourcing it for sales tax than you do for income tax. They're completely different sourcing rules. And more than half of the states now are market-based sourcing or some form of market-based sourcing. Whereas Lauren mentioned, you're looking to where is the benefit received or where is the service delivered. But even those rules vary greatly state to state. And then some states you only look to where the services are actually rendered. And what if it's technology? It's not really services. I mean, there's just so many questions in the sourcing of revenue, and you have to determine the sourcing of revenue, again, as I mentioned previously, before you can determine whether you have nexus. And then the one last point on this is that then, technology companies, the goal is to build the technology and sell it. Well, if you sell it and you make multi-millions of dollars, then all these states maybe that, okay, I'm not going to worry about these other states where I may have had nexus, a small amount of revenue because I didn't really have a lot of profit. Well, that year of sale, you have a huge profit, and all of those states are going to want a piece of that. And how do those rules work? And there are ways to minimize that and to plan for that. And it depends, states have different rules, but it literally, I think, can be a state feeding frenzy when that huge multi-millions of dollars of gain is sitting out there for a technology company where you have users everywhere.
So the last industry we want to touch on is the manufacturing industry. And again, I think they're still in the why stage. You really understanding the impact that Wayfair has on them. Now, manufacturing does have a little bit of carve out and a little bit of relief with some states do provide a exemption for filing and registrations if it's wholesale only companies. But if you're a manufacturer selling to an end user, you really have to understand all the economic nexus guidelines. And for manufacturers, what we're seeing are some of the bigger challenges around compliance is around exemption certificate management. Because even if you are registered in all these different states and have exempt sales, that is a huge burden to collect exemption certificates in 40 some states. So collecting, validating, storing, renewing, that does become an extreme burden put on the tax department. The other area that we're really seeing manufacturing industry impacted is with customers requesting credits for supplying delayed exemption certificates. So you're a manufacturer, you have Nexus, you start collecting tax, your customer has not provided you an exemption certificate, when you started collecting tax, they provide it 2 years later. Now you have to deal with the process of issuing refunds. So that is a big compliance challenge for manufacturers. And then on the purchasing side, certainly other challenges are around supply chains with new suppliers, most of them all charging tax. Knowing that your purchasing department or procurement department needs to get exemption certificates to those new suppliers because they're collecting tax because of Wayfair, it just becomes another issue for manufacturers to understand to make sure that they are taking advantage of all the different exemptions out there by giving those exemption certificates to their suppliers. And then, of course, the contraction of workforce and sales tax responsibilities shifting within personnel. There's usually a lack of training, lack of procedures, and of course, just increased complexity with this rapidly changing sales tax world. And then finally, of course, increased audits with registering and filing returns in more states. There are going to be more audits. So another Wayfair burden.
Yeah, and I've seen some auditors just be really unreasonable. I know, Lauren, you have too. And, it used to be you could be kind of reasonable and you work back and forth, and it seemed to just be better relationships in the past. Now it seems like everything's just rubber stamp denied. Everything's denied.
Yeah. And they really go after the low-hanging fruit.
Yeah, and if you're a big company, obviously they're going to park out and live there. But anyway, on the income tax side, the importance of Public Law 86272. If you're just manufacturing product and shipping it, you want to make sure you do an analysis and document how you're abiding and falling within that. Even set tax policies for sales reps that they can only do certain things and not do other things. Because really, it's the state's feeling right now that no one really qualifies for protection because everyone's doing something over the internet. And let me reiterate, you're doing anything over the internet with your client or accepting online employment applications for non-sales positions, any industry, you're doing any kind of activity over the internet, that state says you have nexus. So, unless it's a really small amount, it's unconstitutional, and that's judgmental, and the states haven't given thresholds. So you really have to look at the nexus area in income tax. There are some specific industry sourcing rules, government contractors. Sometimes there's single sales factor election, specific rules on dock sales. Throwback sales means that if you're not taxable in the state where you're shipping it to, it gets thrown back and included in the state for apportionment purposes from where you're shipping it from. So that changes the amount of income tax. So it's always beneficial to make sure, this be only small manufacturers because most have nexus in more than one state, but you always want to make sure you have nexus in more than one state. Otherwise, you can't even apportion. So you want to make sure you're not protected under Public Law 86272 in at least one other state so you can apportion. Generally, if you're a C corporation or owners of a pass-through entity live in a non-taxing state, there'll be benefit for you there. Next slide. Polling question. Manufacturers are most impacted by the Wayfair ruling for both income and sales tax. So again, is that true or false? Manufacturers are most impacted, more impacted than other industries by the Wayfair ruling, and for both income and sales tax, true or false. And I know we're going to run over a few minutes, but we won't go over an hour, I promise, but we'll be able to get through some additional information here. Okay, give you a few more seconds and we'll be closing that out. Again, we're trying to be generous to people that might have stepped away for a second. All right, and our answer is false. Very good, you've been listening. Technology industry, I think personally, I'm sure there's other industries they would argue, but I think technology is the one most impacted. Okay, moving on.
So the next area, just to touch on quickly, are international sellers. And, unfortunately, I think international sellers think, oh, well, I'm international. Wayfair does not affect me. But unfortunately, for sales tax, they are still subject to all the same laws and regulations, economic nexus as domestic companies. So same compliance requirements, same penalties for non-compliance. How about income tax, Kathy?
Yeah, so for income tax, it's very interesting because international sellers may not be subject to income tax for federal purposes under treaty protection because they don't have a permanent establishment. Many states will allow that treaty protection, but treaties apply only at the federal level, not at the state level. So states don't have to abide by the treaty, and there are states that will impose income tax even if you don't have a federal income tax obligation. So you may have to do a pro forma federal return to file or to prepare an income tax return. So there is some negative impact certainly for international sellers.
So then just looking at what's coming up. So some trends that we want to see is, certainly all the states have an economic crisis, the state budget shortfalls, but they're very reluctant to impose additional taxes. So the movement of choice is really going after non-compliant sellers. So looking at sending out Nexus questionnaires, we've seen a lot of states. There's about eight hot states that are really getting very aggressive with remote sellers. Those states are California, Massachusetts, Minnesota, Pennsylvania, Washington, Wisconsin, Illinois, and Maine. They are all being very aggressive going after non-compliant sellers. The other thing that we're seeing quite a bit of is when companies register, there's a lot of scrutiny to make sure that that registration date is the true date that they should have registered. Otherwise, red flags will go up. A lot of states are getting data mining from other tax types. Arizona is one of the leaders in this, and they are bringing in data analytic firms. And just really all the states are getting data from outside sources just to find all the non-compliant sellers. Typically, the first move is to send in a friendly nexus questionnaire, but the friendly nexus questionnaire will quickly turn into a real unfriendly nexus questionnaire if it is not responded to.
Remember the good old days, Lauren, when everyone would just throw away those Nexus questionnaires and, you might not ever hear back from the state anymore. Now you do that and you will get an arbitrary assessment and they will
Do
lean your bank
not throw
accounts.
away nexus questionnaires.
Yeah, they'll lean your bank accounts and it ends up really, really difficult trying to get rid of those liens. Income tax nexus litigation. I'm just expecting litigation. What is the threshold for income tax? And not only in the area of nexus, but interpreting those sourcing rules. The sourcing rules got more complex, not easier. It used to be kind of where are you performing the service? You know where that is, where the people are located. But now with market-based sourcing, you can come up with all kinds of different arguments on sourcing. So we're going to see a lot there. So the question is no longer, do I have Nexus, but what is protecting me from Nexus? If you have a revenue coming from that state, what protections do I have from Nexus? We're going to see those aggressive challenges as the states start adopting the new MTC Statement of Information. Congress can act and they can override in a lot in this area. They can definitely control interstate commerce or taxation of interstate commerce, but will they ever act? Probably not. You have various interests involved, and then you have Congress just so divided on everything anymore, it's hard to get anything passed. But hopefully, and I will still always continue to push to get some movement to protect small business. We really, really need protection in the small business area.
Yeah. So I know we're running out of time, so just want to touch on a couple other issues. So the expansion of marketplaces, certainly this is an area that everybody needs to keep their eye on. Some of the hot topics are really the definition of a marketplace and then the kind of the audit support or what happens in the audit. So who's responsible for providing audit support, who's liable for incorrect tax compliance, and who pursues refund claims. So we're going to see a lot of evolution with the marketplaces, but certainly it was great to help small sellers, but not without a laundry list of issues to consider. The other area to really focus on for sales tax is the expansion of the drop shipping business model. Certainly a very complicated fact pattern with various different states and what exemption certificates can prevent double taxation. So if your company is in the drop shipping business model, certainly this is something that you'll want to pay attention to. And then the last area is just really the expansion of the tax base with new technology, new sources of revenue, taxing, and you can forward the slides, taxing software as a service, information services, data processing. Not every state taxes these, so the states that don't currently tax technology and digital goods, we will see some movement in that area, as well as evaluating current exemptions. And the last topic, which we'll have to save for another day, is local tax simplification and how to handle the pesky Colorado, Louisiana, Alabamas of the world. So we're running time to get to the last polling question here. So what are your biggest Wayfair challenges? Understanding the Nexus footprint, implementing systems to comply, just not enough resources to file all the tax returns that are needed, or all of the above?
And Lauren, we have a couple questions I think you can answer real quick while we're waiting. The first
Sure.
question is, if you have economic nexus for sales tax with a state, but your revenue stream is not taxable, do you still have to register?
No, not necessarily. You need to look at the state by state guidance, but if you are not selling anything that is subject to tax, that was never subject to tax in the first place, then in most states you do not have to register for sales tax.
And we always say there's always the exception, so you
There's
want to make
always the
sure.
exception.
So look where if you have a lot of sales in one state. And the other one is, are the thresholds for e-commerce cumulative since you started business?
No, and that's a great question. It of course it varies from state to state, but most states will look at a calendar year basis. So if you hit that threshold in a calendar year or the previous year, some states are a rolling 12-month period. So it's important to actually understand what that time period is that you have to count.
And we have charts that tell you exactly what that threshold is, I believe, on our website, right, Lauren?
Yes, we do tell you what the thresholds are.
And that would be on the Cherry Bekaert website. And you would just, I think, search for Sales Tax Nexus.
Yep. Yes.
Okay.
So everyone get a chance to answer?
Well, there is one more question. I wonder if we could just get real quick. You touched on international sellers paying U.S. sales tax, but will you do a webinar? Okay, on domestic business selling internationally. Whoa, that's a great question. And we will give that to our international team because I think that would be very valuable. So we want to just really thank everybody for joining us. We really appreciate it. I'm hoping that you found the information helpful.